Did you know that a quiet change in the tax rules next month could turn your state pension into a tax bill? For the first time in history, the money you worked your whole life to secure is about to be treated as taxable income by an automated system that doesn't care about your plans. If you believe that pensioners deserve a fair warning before the rules change, make sure to tap that like button, subscribe to the channel, and turn on notifications right now. This is a safe space where we decode the fine print, so you don't get caught out, and staying connected is the only way to keep ahead of what comes next. Let's slow down and look at what is actually happening here, because the headlines are scary, but the reality is a bit more nuanced, though no less important. For years, there has been an invisible line in the sand drawn by the taxman. That line is called the personal allowance. It is the amount of money you can earn or receive in a year before you have to pay a single penny of income tax. Currently, that number stands at £12,570. For a long time, the state pension was comfortably below that line. It meant that if your only income was the state pension, you were safe. You didn't have to fill out a tax return, you didn't have to worry about tax codes, and you certainly didn't have to write a check to HMRC. But that comfort zone is disappearing, and it is disappearing because of a collision between two different government policies that are now working against each other. On one side, you have the personal allowance. The government decided to freeze this number. It is stuck at that £12,570 figure, and it is not moving. It is frozen solid until at least 2028. On the other side, you have the state pension. The state pension is protected by something called the triple lock. This is a guarantee that the pension will rise every year by whichever is highest out of inflation, wage growth, or a minimum of 2.5%. Do you see the problem? One number is standing completely still, nailed to the floor. The other number is marching upwards every single April. The gap between them has been getting smaller and smaller, and now we have reached the tipping point where they are about to cross. The full new state pension is currently sitting at roughly £11,500 a year. That sounds like it is still under the limit, and it is, but only just. When the next uplift arrives, likely in April, the forecast suggests the pension will push perilously close to or even exceed that frozen personal allowance. This is the fiscal drag you might have heard economists whispering about. It sounds technical, but it is actually very simple. As your pension rises to keep up with the cost of living, the tax threshold stays the same. You aren't getting richer in real terms, but on paper, you are earning more, and that more is now taxable. This creates a brand new experience for hundreds of thousands of pensioners who have never dealt with the tax system in their retirement. Why is this hitting people next month? Because the administrative wheels at HMRC are turning. They are matching up the new pension figures with the frozen tax thresholds. When they find a mismatch where your income is higher than your allowance, they have to act. And the way they act is not by sending a friendly email or giving you a call. They send a letter. It is called a simple assessment. It is important you understand what this document is, because it looks official, and it can be quite frightening if you have never seen one before. It is essentially a tax bill. It lands on your doormat and tells you that you owe money to the Crown. For someone who has been retired for 20 years and has never owed a penny, this can feel like a sudden accusation. It can make you feel like you have done something wrong, even though you haven't. You played by the rules, you paid your national insurance, and you claimed your pension. The only thing that changed was the math. Let's walk through a real-life example to see exactly how this plays out in a normal household. Imagine a woman named Margaret. She is 76 years old. She lives alone in a small bungalow she bought decades ago. Her husband passed away 5 years ago, and she manages her own finances. She receives the full new state pension. She also has a tiny works pension from a job she held for 10 years back in the 80s. It only pays her about £60 a month. She also has a building society account with a few £1,000s in it, earning a bit of interest. For her entire retirement, she has assumed she doesn't earn enough to pay tax. She was right until now. The state pension increase pushes her total income right up to the edge of the allowance. The interest from her savings, which used to be tax-free because she was under the limit, is now the straw that breaks the camel's back. Suddenly, her total income is £100 over the £12,570 limit. Margaret is now a taxpayer. She might only owe £20 in tax, 20% of that £100 overhang, but she is now in the system. And being in the system means she has to pay that £20. If she ignores the letter, the trouble doesn't go away. This is the part of the video where I need to ask you a small favor. If you are finding this information useful, please take a moment to pause the video and share it with a friend or family member who is retired. You can also smash that like button. It really helps the algorithm show this urgent warning to other people who might be blindsided by these letters. We are all in this together, and looking out for each other is how we stay safe. Now back to Margaret's story. The letter arrives. It is a brown envelope, usually with an official HMRC logo. She opens it, sees the words tax owed, and her heart skips a beat. Many people in her position panic. They think they are being audited. They think they have made a mistake on a form they never filled out. The first instinct is often to hide the letter in a drawer, or to panic and pay it immediately without checking. Both of those reactions are mistakes. The simple assessment is not a fine. It is a calculation, but, and this is crucial, it is a calculation based on data HMRC holds, and that data is not always right. They might have old information about your savings interest. They might have missed a charitable donation that is tax deductible. They might have you listed as employed when you are actually retired. If you pay it without checking, you might be paying tax you don't actually owe. So, who is most at risk of getting caught in this new trap? It is not just the super wealthy. In fact, wealthy pensioners already have accountants and complex tax arrangements. They are used to paying tax. The people who are going to feel the shock the most are the Middle Britain pensioners. These are people who have a full state pension, maybe a modest private pension from a career in teaching, nursing, or the civil service, and perhaps some savings interest that has finally started to pay a decent return due to higher interest rates. It is the combination of these three things, the pension rise, the frozen threshold, and the savings interest, that creates the perfect storm. Even a few £100 of savings interest could be the thing that tips you over the limit. There is also a specific group that needs to be incredibly careful, those who are still working past the state pension age. Maybe you have a part-time job at a local shop, or you do a bit of consulting work. Your state pension is already using up almost all of your tax-free personal allowance. This means every single penny you earn from that part-time job is likely to be taxed. If you are assuming you could earn up to the $12,500 limit tax-free from your job, you are in for a nasty surprise. Your pension has already spent that allowance. This is a concept called allowance exhaustion, and it catches out thousands of people every year who end up with unexpected tax codes. Let's talk about the specific mechanics of the simple assessment letter, because the deadline is strict. When you get this letter, you usually have a specific date by which you must pay. It is often towards the end of January of the following year, but you should never assume. You must read the letter carefully. The danger is that if you miss the deadline, HMRC starts adding interest and penalties. What started as a £20 bill can quickly spiral. And remember, HMRC has up to 4 years to go back and correct a mistake if they think you owe them money. So if they think you should have been paying tax for the last 2 years, they might send a bill for backdated tax. This is why knowing your numbers today is so vital. We have discussed the problem, and we have discussed the fear. Now I want to give you the solution. I want to give you a clear, step-by-step plan to protect yourself. This is not about hiding money or doing anything shady. It is about using the rules that exist to protect you, rules that the government doesn't exactly advertise on billboards. The first step is the most boring, but the most important. You need to do a simple audit of your own income. Sit down with a cup of tea, get a notepad, and write down every single penny that comes into your household over the course of a year. Write down your state pension. Write down any private or workplace pensions. Write down any wages if you are still working. And crucially, write down the interest you expect to earn on your savings. Don't guess. Look at your bank statements or ask your bank for a projection. Once you have that total, compare it to the personal allowance of £12,570. If your total is below that number, you can relax. You are safe for this year. But if you are close, you need to watch it like a hawk every single year. The second step is a golden opportunity that millions of pensioners miss every single year. It is called the marriage allowance. If you are married or in a civil partnership, and one of you is not using all of their personal allowance because their income is low, you can transfer a slice of that unused allowance to the other partner. Currently, you can transfer 10% of your allowance. That is over £1,200 of extra tax-free income for your spouse. In real money, that saves you £252 a year in tax. That is a significant amount of money for a pensioner on a fixed income. Yet hundreds of thousands of couples fail to claim this. It is free money sitting on the table. Even better, if you didn't know about this and were eligible in previous years, you can backdate your claim. You could get a check from HMRC for over £1,000. If you think you might qualify, go to the government website and search for marriage allowance. It takes 5 minutes and costs nothing. We are now reaching the halfway point of our deep dive, and I want to make sure you are still with me because the next steps are the most technical. If you are finding value in this detailed breakdown, please make sure you are subscribed. I am committed to bringing you the truth behind the financial headlines, and your subscription is the best way to ensure you never miss a vital update. Now let's get back to protecting your money. The third step involves your savings. We mentioned earlier that interest on savings counts as income. This can be the silent killer that pushes you over the tax line. You might not think much of that 3 or 4% interest you are getting, but if you have a substantial nest egg, the annual interest could be hundreds or even thousands of pounds. However, there is a way to make this interest invisible to the taxman. It is called a cash ISA. An individual savings account is a special wrapper that you put around your money. Any interest you earn inside that wrapper is tax-free. It does not count towards your personal allowance. It is not reported to HMRC. It is a safe haven. If you have savings in a regular bank account, you might want to consider moving them into a cash ISA. It keeps your income lower on paper, which keeps you safe from the simple assessment letter. There is a limit to how much you can put in an ISA each year, currently £20,000, but for many pensioners with modest savings, this is a perfect solution. There is also a fourth, lesser-known relief called the starting savings allowance. If your total non-savings income, your pension and wages, is below a certain level, you can actually earn up to £5,000 in savings interest tax-free, in addition to your personal allowance. This is separate from the ISA. It is complicated, I know. But if your only income is the state pension, you might be able to earn significantly more interest from your savings before paying any tax. This is why doing the audit in step 1 is so critical. You need to know which category you fall into, so you don't panic unnecessarily. Step 5 is for those who are still drawing from a private pension. If you have a defined contribution pension pot, a pot of money you saved up during your working life, and you are drawing an income from it, you have flexibility. You can usually decide how much to take out each year. If taking a large lump sum this year would push your total income over the tax threshold, consider taking less. Spread your withdrawals out. By managing the flow of money coming out of your private pension, you can control your total income for the year. You can deliberately keep yourself just under the personal allowance. This is legal tax planning. It is smart. It is using the system to your advantage. Why pay tax this year if you can wait until next year to withdraw that money and stay tax-free? This requires a bit of forward planning, and it might be worth speaking to a financial advisor if your pot is large. But the principle is simple. Control your income, control your tax. Now, what happens if you do get the letter? Let's say the brown envelope arrives next month. You open it, you see a number. Do not panic. This is my most important piece of advice. The letter is not a fine. It is not a criminal accusation. It is a starting point for a conversation. First, check the details. Does the letter list your correct pension income? Does it list your correct bank interest? If you have moved banks recently, HMRC might have the wrong details. If they have estimated your interest based on an average from 2 years ago and your interest has dropped this year, their calculation is wrong. You have the right to challenge it. You can contact HMRC, usually by letter or through your online government gateway account, and tell them their figures are incorrect. Provide them with your real statements. They will reissue the bill with the correct, lower amount, or cancel it entirely. The key is to engage. Do not ignore it. Ignoring it is the only thing that turns a small problem into a big problem with fines and court threats. Let's look at the emotional side of this for a moment. Why does this matter so much? It matters because this feels like a breach of trust. You paid into the system your entire life. The state pension is often described as a right earned through national insurance contributions. To suddenly have to pay tax on that right feels like giving it back. It feels like the government is handing you money with one hand and taking a slice back with the other. And in a way, that is exactly what is happening. It is a stealth tax. By freezing the threshold, the government is quietly pulling more people into the tax net without ever announcing a tax rise. They don't have to stand up in Parliament and say we are raising taxes on pensioners. They just let inflation do the work for them. That is why it is called fiscal drag. It drags you into the tax net slowly, silently, and inevitably. We need to look at the numbers over the long term to really understand the impact. This year, the amount you owe might be tiny. It might be the price of a nice dinner. But next year, if the pension rises again and the allowance stays frozen, the slice of your income that is taxable gets bigger. And the year after that, it gets bigger still. This is a snowball rolling down a hill. It starts small, but it gathers momentum. In 5 years, the tax-free pension could be a distant memory for millions. The people who understand this now are the ones who will rearrange their affairs, moving savings into ISAs, claiming marriage allowance, managing their pension withdrawals to stay ahead of the snowball. The people who ignore it will wake up in 5 years to a tax bill that is no longer a joke, but a significant drain on their weekly budget. There is also the issue of provisional income for those of you watching who might be close to the threshold but not over it yet. You need to be aware of how HMRC tracks you. They have access to data from banks and pension providers. They are becoming much better at joining the dots. In the past, if you had a small amount of savings interest, the bank might not tell the taxman unless you asked them to deduct tax. Now, under the personal savings allowance regime, banks report interest to HMRC automatically. This is how they generate the simple assessment. They don't need you to fill out a return. They already have the data. This automation of the tax system is what is driving the surge in these letters. The computer sees a number, the computer sees the frozen threshold, the computer sees an overage, and the computer prints the letter. There is no human involved in that decision. That is why the onus is on you to check the computer's work. So let's quickly recap the plan of action I want you to take away from this video. First, calculate your total annual income immediately. Do not wait for the letter to arrive. Be honest and include everything. Second, if you are married, check your eligibility for marriage allowance and apply today. It could save you hundreds. Third, review your savings. If they are not in an ISA, look at moving them to protect the interest from being added to your taxable income. Fourth, if you are taking money from a private pension, think about the timing of those withdrawals to keep your annual total down. And finally, if the letter comes, open it, check it, and challenge it if it is wrong. Use the free services available to you. Age UK and Citizens Advice are brilliant at this. They have volunteers who will sit with you and go through the paperwork. You do not need to pay an accountant a fortune to fix a 20-pound tax bill. I want to leave you with a final thought that might make you feel a little better. While the system is changing and while the tax net is widening, you are not powerless. Knowledge is your armor. The fact that you have watched this video to the end puts you ahead of the curve. Most people will not know this is happening until the letter hits the mat. You know it now. You have time to prepare. You have time to make the small adjustments that keep your money in your pocket. The state pension is a lifeline for millions, and protecting it from unnecessary erosion is not just smart financial planning, it is a way of honoring the work you did to earn it. If this video has helped you, please pass it on, share it with a neighbor, a friend, or a relative. Let's make sure no one gets a nasty surprise next month. Thank you for watching, take care, and I will see you in the next video.